Thank you everybody for joining us today. Myself, Kyle Gears, my colleague Nicole Simos. We're going to walk you through some of the data from Q2. Obviously, a lot is going on in the markets and the economy with inflation ripping, Fed hiking rates. But where did the money go? Where did we see inflows, outflows? What were the trends that we noticed or picked up on throughout the second quarter? During today's agenda, we're going to cover our fund flow reports. Now, these are our flagship reports that you receive via email, but actually have some exciting news for you. You can now access them directly through the website. And then we're going to cover our Q2 visual deck to look at some graphics and really put together the information on where those flows went and why. And then we'll leave it open at the end for some Q&A if anything pops up or piques your interest throughout today's demonstration. Questions can be sent using the Zoom module, so please feel free to fire away on that. And we're also going to send out a recording after the demonstration. Usually takes a day or two to be sent out. But first and foremost, as I wanted to discuss, we do now have the ability to access fund flow reports directly within the website. So if you are a YCharts client, within the support dropdown, we have a direct link to the fund flow reports. Traditionally, we've sent them out and we still will on the 15th of every month, but a lot of times they hit spam folders, they get caught up somewhere or quarantine, you might miss them. So now you have direct access through the site through the support dropdown. So if you click into the fund flows report, that'll bring you directly into the page for 3 primary reports for both the US and Canada. Or should say 2 reports and then 1 visual slide deck. The kicker about this page is you can actually access historical reports as well. So just to quickly review our primary fund flow reports, you have the standard fund flows report, which covers your top 5 and bottom 5 categories for both mutual funds and ETFs. So first page is going to give you some general index data, economic data. As you scroll down, you get into the more interesting fund flow data. So first, you're going to see the top 5 categories for inflows, followed by the funds that led to those inflows. And you might be looking at specific tickers. The way that we handle that is we aggregate all share classes, so net flows at the fund level, and the ticker is just showing the largest share class. Then you move on into that second portion where you see outflows amongst mutual funds, and the same for ETFs. So, make sure you're taking a look at these on a regular basis. Great for insight or even sales ammunition in terms of what areas you want to focus on, or where assets might be moving and why to support an idea. The second report zooms out a little bit and it takes a look at some of the major categories for equity and fixed income. So ugly looking report here as we see a sea of red, a lot of outflows. But what we do is we focus, as I mentioned, on the major equity categories. So you see those on the left-hand side here. We have combined flows for both mutual funds and ETFs. And then we also split it out to show you mutual funds and ETFs on their own. As you'll see in our presentation, we've seen a lot of flows out of funds and into ETFs. And then as you kind of follow down the list here, you see you have major fixed income categories. Everything is focused on those flow timeframes. You also have some support for returns to see if there's some sort of correlation there between flows and returns. Another thing to note about these reports is they are dynamic. So if you click into a specific category, that'll actually open up with that category in YCharts and show you a full list of those products to a point where you can pull in any data that you'd like to see. And last but not least, we also have our deck. This is just a visual presentation that you can leverage or use with some key takeaways or graphics as it relates to flows. Now that we covered that, let's go ahead and jump into those visuals or start taking a look at the deck or our findings from Q2. I want to start out with broad asset flows. And the interesting takeaway here is alternatives led the way in Q2 for inflows. This is an asset class you don't normally see there in the first spot. due to the economic environment, people are willing to take a chance on alts. Oftentimes might have gotten burned in the past. They might not have, worked the way they were expected to, but that was the leading category in Q2. On the other end of things, fixed income, massive outflows. And a lot of folks aren't really sure what to do with fixed income right now, or where to allocate assets to protect capital, to find yield. I mean, there's a lot of risk involved. So I think a key theme of what we'll see across the board here is there's a lot of risk off type scenarios. And one of the interesting things about alts is it's a pretty broad category. So where is the money moving? If we jump over to YCharts really quickly, you can always drill down into this data and see the exact products that are garnering all of the flows. So we have it in the fund screener sorted by alts, and looking at over the last quarter, last 3 months, where have those assets been moving? Victory market neutral, JP Morgan hedged equity, PIMCO managed futures. So a lot of managed futures, a lot of options based strategies, market neutral. So interesting to see, what's picking up the flows as far as alts go. I guess the last thing I would note on this slide is you see miscellaneous, which really captures a lot of the leverage products. So something like the triple Qs or inverse products, bear based products, or shorting the S&P, those type of ETFs or ETNs are usually captured in that miscellaneous option.
Yes, excellent points, Kyle. And I will jump in here and mention, historically, alt funds have not been top performers. However, alternative managers now continue to show momentum, even against the backdrop of high inflation that we're seeing today. Right now, we're seeing inflation at the highest point it's been at in the last 40 years, sitting right around 9% at this time. So lots of economic uncertainty going around, as I'm sure many folks are aware of. And, this inflation and rising rate environment has also contributed to the nosedive of the bond and equity markets, as we can see here as well. Okay, this next slide that we're showing here is giving us a high-level overview of flows for fixed income mutual funds and ETFs in Q2 of this year. We can see government-backed funds taking the lead here, with long government at about 11.56 billion of inflows, followed by intermediate government with 9.6 billion of inflows, and short government at 2.99 billion inflows. This could certainly be thought of as a flight to safety. Right now, the Federal Reserve and other banks are charting the course for the harshest implementation of monetary tightening that we've seen in decades. After their most recent meeting on July 11, the Fed is expected to raise rates by 0.75 of a percentage point. As this rising rate environment continues to persist, we may see investors continuing to pull out of these sensitive fixed income categories in favor of government-backed funds. In terms of outflows, we saw a substantial drop in bond funds, specifically looking at intermediate core plus, intermediate core, and short term. This may stem from a significant weakening in credit sectors, and it also depicts a buying base not willing to express much risk in portfolios, credit, nor duration.
I think one of the interesting things here is, you see all the govies being piled into, as Nicole mentioned, sort of a flight to safety in terms of credit quality. And what I find interesting, I mean, they've gotten beat down pretty bad thus far, but some investors might be thinking that, hey, have rates topped out, or is the Fed at some point going to be forced to put their foot on the brake a little bit? I think that those are two questions that are in people's minds. But if you look at something like a chart of Q2 and how certain proxies performed, looking at 3 to 7 year Treasury and IEI, down pretty significantly, as well as TLT. I mean, the long-term, long or high duration type bets. But timing also plays an issue. So, if we were to kind of look when things turned around a little bit, call it June 14th, when did investors pile into this trade or this investment, based on timing, interesting to take a look at performance, since those proxies or those categories sort of bottomed out a little bit. Jumping back to the next slide, we're going to move on to equities. And this has been a theme. I mean, large caps have continued to pull in assets, and large blend has continued to lead the way. So as mentioned in one of our previous webinars, could it be that investors don't want to pick a side, value versus growth? Well, they definitely don't want to be in growth right now, given this rising rate type of environment, which historically growth stocks have done poorly. Value's held up very well thus far if you're looking at something like a year-to-date time frame. So we see a lot of assets into blend and value. And we also continue to see a lot, as we'll see later, into blend ETFs that track indices. And if we're talking about styles, once again, large cap has pretty much gotten the bulk of those assets due to the fact that they're well-established companies and most of the time with great balance sheets. So if we look at a chart here, taking the Russell 1000 indices, Russell 1000, Russell 1000 growth, Russell 1000 value, you can see in Q2, that's exactly what happened. Value held up significantly better than blend and growth. And even if you scale it back and look at that year-to-date time frame, similar trend, similar situation, which is why we might be seeing some of those asset moves.
Excellent point, Kyle. And before we move on to our next slide here, I will mention that across the board valuations are looking good, but especially for small caps. Small cap funds haven't been this inexpensive in a while, and they've seen a lot of outflows in the first half of this year. At this time, perhaps investor sentiment for small cap funds are looking to be moving in a more positive direction.
Yeah, a lot of the themes that we're seeing in Q2, it's pretty interesting to see, massive outflows and things deep in the red. You got to think about the contrarian play at some point. At what point, is there enough value in this to make a bet on it?
Absolutely. So in this slide that we're looking at right now, we're seeing a similar picture. However, we're going to be narrowing our focus to equity style flows only for the month of June. Large blend ETFs were this month's biggest winners with 17.2 billion in net inflows, eclipsing all of the other style categories we see here combined. If you take a look at the top section of the visual, we will see that mutual funds across all equity styles saw significant inflows. So despite the slumping market performance combined with US equity flows for the month of June, we saw that large blend and large value funds are showing the greatest demand. Notably, we can also see growth-oriented categories suffered the highest outflows in June and have also struggled the most for the year to date.
And I think this just goes back to the theme that we've been seeing, steady streams of inflows into ETFs, and it could be a number of reasons. It could be lower expenses. It could be the ability to trade in and out of them throughout the day. It could be that model managers are using ETFs, so there's more models being built around ETFs. So that seems to have been the trend as of late, and it doesn't seem to have been slowing down based on the last couple of months or quarters. Here we're taking a look at sector specific products, and this is always interesting because you have a lot of tactical allocating going on based on the environment or the market as a whole. And we talked a little bit earlier about de-risking or flights to safety, and that's basically what this chart here is telling us. And it's interesting to see assets pouring out of financials. Deal flow has slowed down given the environment, especially for the banks on the IPO front and whatnot. Definitely a big money maker there. Yes, rates are rising, but looks like investors just aren't viewing financials as a good play right now. You also have technology once again on the heels of rising rates, not where you want to be allocated to. If you take a look at least the top 4 sectors that assets have been going into, if we take a quick look at how those have performed over the second quarter, you could see that the majority of them have performed a lot better than some of the more sensitive sectors. Held up well, all of them down less than 10% on the quarter, whereas the majority of other sectors, especially the more sensitive ones, were down more than 10%. So another takeaway there is it looks like based on performance, that's how some of the flows are aligning and trying to position things tactically and de-risk a bit.
Absolutely, Kyle. And, in terms of financials specifically, quite surprising to see that those outflows in some respects, especially because banks reported better than expected numbers. In a rising rate environment, financials typically are seen to do well. Tech, on the other hand, typically relies on growth. So in this rate hiking environment, we've seen securities in the tech sector just consistently lose assets. On this slide, we are looking at the mutual funds and ETF net flows and performance by equity style. So from this visual, as Kyle mentioned previously, we are seeing that same sea of red. So in terms of, large value and large blends, these are really the sections that have dominated flows over this last year. Large blend consists of many index-based products, and large value is usually a clear-cut play in this rising inflation and rising rate environment.
Yeah, so as Nicole mentioned, not a lot to take away other than large blend, large value over those 3 time frames, both last month and this quarter, as well as over the last year, have seen the bulk of those inflows. We've been talking about inflation and potential rising rates for a while, and it looks like investors have positioned themselves for that to occur. This slide's always interesting, active funds versus passive funds. And basically the way that we determine this is the product tracking an index? If it is, it's considered passive. If it's not tracking an index, it's considered active. And what we see here is just the difference between active and passive as a whole, as well as breaking out individual ETFs and mutual funds. And across the board on the passive side of things, granted, you always have to take the data with a grain of salt. It's there for you to interpret how you wish, but there's assets coming in, like I said, from models, or call it robo advisors and things of that nature. So I'm sure there's always going to be a lot more passive flow for those automated type investing purposes, but continue to see, pretty big disparity there between passive and active. Although you're looking at the active ETF side of things, you do see both in June and in Q2 inflows to active ETFs. So that wraps it up for our Q2 fund flows presentation. If you're interested in subscribing the fund flows report or subscribing to the fund flows report, you can access it through go.ycharts.com/fundflows-opt-in. However, if you are a client, especially on the asset management side, you will automatically be receiving the fund flows report. It's emailed to you. Like I said, we do have some issues every once in a while. It is an automated email, so it might hit your spam folder, might get caught in a quarantined folder. However, you do have the ability to access it directly through the support tab on the website. And for those previous period fund flows, you can also access those, as I just mentioned, through our fund flow report library resources dropdown. Let me go ahead and just run you through how to access that one more time. Go to support, fund flows report, and that'll bring you to the fund flows library. You have our recent reports up top, as well as our visual deck, and then all of our historical fund flows. Go ahead and take a look to see if there's any Q&A questions. Doesn't look like there's any there now. If you have any questions, feel free to pop them in the Zoom module. Happy to hang back for a minute and answer them. But if not, hopefully these insights were valuable. You've learned something new today, or at least know how to access our reports through the website. If you're not using the Fund Flow Reports currently, highly recommend doing so. Adds phenomenal insight to engagement with clients. Looks like we had a quick question on what indexes are you using for performance numbers. So as far as some of the performance numbers, for example, the Russell indices we're taking a look at for large cap, large growth, large value, large blend. For looking at government, long government, use TLT, intermediate, IEI, just proxies to capture those categories. And then for sectors, using the spider sector ETFs. So as you can see here on the left-hand side. All right, everybody. Well, thank you for joining us. Looking forward to hosting you for next quarter's Fund Flow review. And as always, if you have any questions, please don't hesitate to reach out to Nicole, myself, or anybody else on our YCharts support team. Have a great day.